Today, we're going to talk about real estate investment trusts, or REITs. They're a great vehicle if you want to invest in real estate but don't have the money for the down payment. And also if you're just not interested in buying any physical property. Let me show you how they work. But first, why would you consider REITs instead of buying actual property? Two words: money and stress. To purchase a property, you need a down payment, and that's 5 to 20% of the total value of the house. On top of that, there's closing costs. That's 2 to 5% of the total amount of the loan. And then once you have the property, you still have to pay property taxes every year and maintenance fees. And even if you decide to rent it to somebody else, you still have to find that tenant, deal with any issues, and pay for the mortgage if there's a vacancy. That's where REITs come in. They allow you to invest in real estate without any of the headaches of traditional homeownership. And on top of that, they let you start with just a few dollars as opposed to thousands of dollars that would be needed if you were to buy real property. What is a REIT? A REIT is a real estate company that owns and operates several properties and returns the income from those properties to its shareholders. There are different types of REITs. Some have a diversified portfolio across all types of properties, and others focus on particular types like retail, hotels, commercial, industrial, etc. When you own a REIT, you basically are a mini landlord. Instead of owning one property, you own tiny pieces and hundreds of them. And then by law, the REIT has to return 90% of its income back to its shareholders in the form of dividends. That's money in your pocket. And when you want to sell, instead of having to put the house on the market, you can just easily sell a REIT on an exchange because they're listed on the exchange and traded just like stocks, and they're what we call liquid. It means you can buy and sell them at any time. There are also baskets of REITs like real estate mutual funds or real estate ETFs and even indexes that someone can track. Now let's talk about the risks. Every investment has a risk, and REITs are no different. First, anything that affects real estate prices will inevitably affect REITs. Remember, real estate prices are cyclical. That means that they rise when the economy is booming and they fall when the economy is facing challenges. So you might remember during the Great Recession, property prices plunged. That could happen again. The second risk is interest rates, because REITs are sensitive to interest rates. If you were buying a physical property, you'd be closely monitoring interest rates because any rise in interest rates would affect your mortgage. Your mortgage would become more expensive. You're not getting a mortgage now, but interest rates still play a role. When interest rates go up, the yields on bonds go up, and that means they become more attractive than yields on REITs. So investors sell REITs and buy bonds. That pushes prices down. There's an exception, however. If interest rates are rising because the economy is hot, that means that the rental income that REITs have might be rising as well. So that could increase your revenue. And finally, any problem that can arise with real estate, like a bad tenant or structural problems, can also take place with REITs. Think of what happened with commercial REITs that are mainly offices after the pandemic when all offices were empty. Yes, you won't be the landlord yourself, but those problems will be priced in. So should you buy a REIT or a real property? As always, the answer is it depends. Like with anything else you're buying, the main question is, why are you buying this? If you want a place to live and you can afford the down payment, then real property might be for you. But if you want to start with a small amount of capital, you're just seeking diversification and some extra income, REITs could be a good solution. As always, talk to your financial advisor to figure out what's best for your individual situation. And we'll see you next time.